Joining me today is Mark Ewart. Mark Ewart is a 20-year advisor in the Private Wealth Management Division. He works out of the Niagara Peninsula office. We've asked Mark to join us today to share some of his thoughts on portfolio construction and the rate of returns that he provides his clients. Talk a little bit about how he manages monies for his clients as well. Over the past number of years, we've been evaluating the rate of return on individual and aggregated performance of portfolios in the Private Wealth Management Division. And Mark and his team have consistently provided top quartile returns for their clients. And more importantly, they've provided below average risk and below average variability to those same clients. So Mark, you've obviously done a fair amount of research into this area. I'm wondering if you wouldn't mind taking our audience through a little bit of some of the work you've done there.
Sure. And it was research that I think just continued to grow. As I would look at one thing, it would cause a question that would make me say, well, I need to look further, why this and why this? And very recently, our CEOs talked a lot about typical versus optimal results. And he actually had that graph set up where he showed over the lifetime of an investor where they typically wind up and what really is possible. And the gap is fairly significant. So when I started looking at that, one of the first pieces of research that really triggered me wanting to dig deeper was research that JP Morgan comes out with every year. So here this shows the 20-year running average, or what the annualized rate of return was for 20 years in the stock market and the bond market, and what the average investor got. And I would look at something like this and think, this doesn't make any sense. A portfolio for most people is constructed of some stocks and some bonds. So if stocks have averaged over the last 20 years about 8.2, bonds 5.3, then how do you take some of this and some of that and come up with a rate of return of 2.1? That bothered me. It stuck in my head and said, first of all, this is not going to happen to my clients. So if that's the case, I need to find out what it is that's causing this and how do we avoid this mistake from happening. Because when I went and looked at further research like this, JP Morgan comes out with a report like this every single year. And it didn't matter whether I was looking at the one that went from 1980 to 2000 or 1996 to 2016, the graph was always the same. Stocks were up here, bonds were down here, and the average investor, who should have just had something in the middle, was really losing out at the bottom end. And the more research I started to do, Dalbar is a firm that for the last few decades have really looked at what type of rates of return have investors been getting, depending on whether they're all equity investors or all fixed income, or whether they take a diversified approach of some stocks and some bonds. And when the last report came out for this last year, and they showed the 10-year average was 1.78% per year for the last 10 years for someone who is invested in a portfolio of part stocks and part bonds. And inflation over that same time period was running at about 1.83, so they're not even keeping up with inflation. So the more I looked into this and thought, there's a very chronic problem that's happening here in the industry. What do we need to do to avoid that from happening? And Dalbar really pointed out that the single biggest cause of underperformance is investor behavior. And when I spoke to either groups of some of our clients or groups of advisors, the one thing I caution is, it says investor behavior, and some advisors would say, well, see, there it is over there. So it's the client's fault because they're not sticking to the plan that I've laid out. But I think it should be called investor behavior and advisor behavior, because advisors are sometimes just as guilty of not sticking with the plan as the investor is themselves. So I think what really happens is, in a quest for either the investor or the advisor to get rates of return that are somewhere up here, they wind up down here. And what I have said I'm going to focus on with my clients is getting that return right in here. If their portfolio is part stock and part bond, how are we going to do this? How are we going to not deviate from the plan continually again and again? So in doing that, I needed to say, all right, well then, if I know that the number one cause of underperformance is because people won't stick with the plan, they won't hold an investment long enough to generate that rate of return, what is it that's causing people to deviate from the plan? And I isolated it down to really four things. So if they have a low return over a short period of time, somebody gets a quarterly statement and the rate of return is not that good, or they've got a year where things are not good and they say, you know what, my rate of return was low for this 12-month period, we need to change everything. That is one trigger for deviating from the plan. Or they say, oh, I got a reasonable rate of return, but my brother-in-law or my neighbor or my coworker they were invested all in this area and they did fantastic over the last 12 months. Maybe we should pull everything out of what we're doing and follow exactly what they're doing. And unfortunately, then they've probably bought high, and whatever just did good over the last 12 months is going to drop from that period of time. I also found you can have an investment that might have a great 10-year track record, but if the volatility is too high, people are not going to stick with the plan. So what we really need to do is get from point A to point B with a reasonable growth and try and stick as close to that growth line as we can for that entire period. And the fourth thing is people's perceptions about fees. And that's something I think in the industry that's really becoming more and more prevalent, as the regulators are saying we want more and more disclosure. Stuff's got to show up in statements, which I think is fantastic. It should be as transparent as possible. I'm also aware that there's going to be a lot of misconceptions about that, and possibly even, a financial advisor pointing at another type of investment and giving a little bit of misinformation. Like, I think people think if my fee is lower, then my rate of return is going to be higher, and there's not always a very strong correlation in that area. So I think those are the 4 areas that I would look at.